we have everybody on board. Andrew has requested if you're in a position where your internet can support these, kindly put on your video. It will help in engagement for the session. We're going to give it just another 2 minutes to get a few more people onto the session, and then we're going to get started. So if you're in your slacks or in your pajamas, this is the time to put on a shirt and then you can put on your video. Andrew usually have some music that Joyce plays for us, but since you only have 1 minute, you're not going to play the music today. You know, I've attended a couple of sessions where you come in and everybody's quiet, they're looking at each other and nobody knows just what to do. So the music helps, at least people are like, okay, at least, you know, yeah. So allow me to share my screen. We're going to be getting started in a couple of minutes. So I think we can get started. Joyce, we can get started. I think we have enough people in the room.
Yes, we can.
Okay, brilliant. So hello, everybody, to this session, this live session, which is going to be on sensitivity, scenario, and foreign currency translation. We're very fortunate to have Andrew and Arup in the session. I'll speak about them in a second. Yeah, let me just get started. I'm going to make just a few introductory remarks. Then I'm going to hand over to Andrew, who's going to be facilitating this session for today. So in terms of where we are at with the sessions, we started on 18th of May. We are on week 4, and time is moving really fast. Not on week 4, we're on week 3, sorry, and there's a couple more sessions coming in. So we've already gone through this session. Today we're dealing with the sensitivity and scenario analysis and foreign currency translation. Really excited to have Andrew with us. After that, we're going to have a Q&A session later this week where we can get to ask any questions that we're encountering based on the content either today and the content that we've covered so far. And so it's you know, my pleasure today to welcome Andrew, the Managing Director at F1F9. Just a quick story about Andrew. I met with Andrew way back in the year 2013. I have to credit Andrew and the team at F1F9 as part of the inspiration of starting Investia, because Investia was started almost as a mirror image of what F1F9 does, which is they build financial models for clients using the FAST methodology, and they do training using the FAST methodology. And so we've learned a lot by talking. I shouldn't say following, I should say talking them online and seeing what they're doing. And they've been a very good source of inspiration. A bit about Andrew, and I'm sure he'll also do a quick intro about himself. He spent some time in corporate finance, 7 years in corporate finance. Then he started doing financial modeling training, and he's been at F1F9, I don't know for how many years so far, but for quite a number of years. He's a very experienced trainer. Whenever I attend the sessions that he's facilitated, I learned quite a bit. We shared with you a recording earlier this week on financial modeling standards, which was recorded last year during a conference on financial modeling. And during that conference, Andrew was one of the speakers with a couple of other experienced players in the financial modeling space. So he comes with a lot of experience. So I believe that when we get to the Q&A session, he would be able to answer any question that you may have, even outside the content that we'll be discussing today. On top of that, he's going to be working with Arup, who's from F1F9 also. And I think, Andrew, I think you'll do the introduction for Arup on top of that. And we're really looking forward to the session. I'm going to stop there, Andrew, and hand over the session to you. Andrew has requested that if you're in a position where you can put on your video, kindly put on your video. That's going to assist in just ensuring that the interaction is really good. You've already probably received the start file. If you haven't, just shout and we'll send that through to you. But also, Joyce is going to be sharing that on the chat function in a bit. Andrew, over to you.
Stephen, thank you very much indeed. Well, look, good morning, everybody. Very warm welcome to this session on sensitivities, scenarios, and foreign exchange. And before we begin, so even before I do some introductions, let me just make sure that that we're in communication with all of you. So I've seen, I can see Jeffrey on the screen, and Jeffrey is doing a great job of putting himself on mute. And I'm going to recommend that you do that. Just keep yourself on mute. But here's the deal: if you wish to interrupt me and ask a question, just do so. Take yourself off mute and ask away. I'm delighted to be interrupted at any point during our time together. So can I just check with some of the other people? For example, I can see we've got Nancy. Nancy, are you able to show yourself? Do you have a camera?
I do have a camera, but it will take me an hour to prepare to be presentable. So I'm not sure if I have an hour.
All right, no worries, Nancy. No, it's good to know that you're here. And let me just check again. I'm just going down some of the names that I know. Well, let me just go down some names. What about Valentine or Valentine?
Yes, I can. I can put on my video.
Wonderful. Okay. All right. So you're from. Oh, there we go. Valentine. That's great. I can see Caroline here as well. That's wonderful news. And who else have we got? What about Adelaide?
So I'm putting on my camera in a minute.
Right. Wonderful stuff. Okay, and somebody else. We got Kazar coming in there, and so the only person I'm missing now is Jane.
I'll be putting on my video in a minute.
Yeah, no worries. Okay, you take your time. Good stuff. Well, look, the reason why I asked to see faces is just it means that engagement is so much better, and then I can see whether you're happy, confused, sad, or bored, or where you are, and it's just nice to know and nice to pitch in. So thank you very much, Stephen, for the introduction. All I will say to add to my introduction is that it's a great pleasure to be here. You know, F1F9 and Investia have been sort of interested, I suppose, in each other's work for ever since Investia started, and as Stephen says, we met together in London, and it's great to come along and run a group session. When I do teaching, I do tend to have a second instructor, and that's why we've got Arup also from F1F9 on the call, and Arup and I are very good at working together. Arup knows exactly when to interrupt me, exactly when to ask the questions that you're all thinking but daring not to ask, and so you know, we'll run that together. And Arup is part of F1F9's model build team based in India, but also so Arup builds models for real, and also gets heavily involved in training as well. Arup, do you want to add to anything to that?
Thank you, Andrew. I think you have covered everything probably. I would just add that I am a project manager at F1F9, and I have been a full-time employee of F1F9 for 6.5 years now. And like Andrew said, you know, yeah, I do model build. I also work with training. You know, it's like I have fingers in all the pies, you know. So that's about it. Thanks, Andrew. Over to you.
Good. All right. Thank you. Well, look, just a couple of other things. So first of all, I've said, by all means, interrupt me as you go through. You know, please do. Discussion is good. The other thing I'm going to recommend is that you don't attempt to model while I'm modeling. I think it's much more important that you're looking at what I'm doing and rather than trying to repeat it on a screen in front of you. However, having said that, you have got a copy of this model to play with, and I'm also going to give you a copy of where I end up at the end of our 2 hours together, and plus a more finalized version of the model as well. And in fact, the first thing I'm going to do while I think about it is let me do a save as on this model. I'm just going to save this model, and let's call it something a little bit friendlier. It's currently called Matt Start Model FX Model. Oh my goodness, you know, let's simplify that down a little bit. I'm going to call this, what should we call this? Let's just call this Matt 04A. Okay, I think you can call it what you like. And one of our recommendations, certainly with models that we build, is you want something nice and simple, nice and short for your model. Otherwise, you're just wondering what all those abbreviations are going on. Good. Now, I am going to head off to the temp sheet, and let's think a little bit about an agenda. So we have got just under 2 hours together. I'm expecting to finish in about 1 hour and 45, and I've got a lot to share with you. Okay, so this is going to be quite a fun-packed session. We're going to talk about scenarios and setting up scenario managers, and connected with that, we're also going to look at sensitivity analysis. Okay, and that is going to involve me setting up a new worksheet in order to manage the scenarios and the sensitivity analysis. We're then going to look at the modeling of debt. And in particular, we're going to look at modeling debt where we have got foreign exchange considerations. And in particular, with this scenario, we're going to be looking at a project where the functional currency is Kenyan shillings. And I'm going to talk a little bit about what I mean by functional currency as we go through the course. But we have got debt being put in US dollars. And therefore, the question is for you as a modeler is how do you deal with that? And particularly, how can you model risks associated with foreign exchange rates changing? Okay, so we'll look at debt, foreign exchange considerations. We're going to look at scenario sensitivity analysis. Couple of other things to mention. One really important piece of quality control that I'm going to be looking at is something called the track sheet. And that is a sheet that you'll see that we put in our model. And that's something that is really important in terms of us understanding what we're doing to our model, how it's changing and things like that. And we'll take a look at that. So that's my plan. And I suppose if I were to, I mean, this is a rough agenda, I suppose. Let's say, let me just add a little bit more in here, a little bit more description in here. So we're going to say, setting up a send sheet, setting up a scenario worksheet. And then if I take a copy of this again and drop this down, we're going to return to scenarios and sensitivity analysis and think about, what should I call this? Running break-even testing. Okay, and then just thinking a little bit more about debt, let me pop another topic in here, which is going to be looking at ratios. And in particular, we're going to be looking at a couple of lender ratios. Okay, any questions or any comments on what I'm planning to cover? Wonderful. Well, the other thing I should tell you really to begin with before we get started is the importance of this yellow color. You are going to see me using this yellow color all the way through my modeling. And I just want to check in with your studies so far. Can anybody tell me, why am I marking everything in yellow? Okay, well, let me.
I guess you don't want me to answer this, so I'm not going to answer. I'm not going to answer his.
No, I don't want Stephen to answer this. I was wondering if you'd come across it on your study so far. Okay, the point about this yellow color is it's my signal to you that I've got work to do. So it's my signal to you that what I've put up in my model is temporary. It's unfinished. And when I model for real, this is how I model. I will start sketching out an answer using yellow to get any sort of rough answer in place. And I will then work on that answer and refine it and get it better and better. So to begin with, you're going to see me doing a fair amount of what I'm going to call bad modeling. Bad modeling, where I'm going to be breaking all the rules that you've learned so far. But because the color that I've put in is a nice yellow color, what I'm going to call a placeholder color, it's my indication to you that I'm going to come back and I'm going to do more work and I'm going to improve what I've done. Okay, Stephen, was that your understanding of what I was going to say?
Indeed, exactly.
Right, good stuff. So let me begin. I'm going to set up a new sheet. I'm going to set up a scenario sheet where we're going to, if you like, set out where I'm hoping to get to at the end of the session. I'm going to head off to my template sheet on the far right of my model. That template sheet really exists for two reasons. First of all, you've got stuff on the worksheet that might be useful that you can use again. But perhaps even more important is that it's going to give me a sheet that has got formatting. And let me just take a copy of that sheet. I'm going to drag and drop that sheet, take it right back. Where should we put this? Let's pop this. I think we're going to pop it next to my, just for my FinStat sheet, actually. Let's drop that down there. Sneaky double click down the bottom here, and we're going to call this Sen for scenario. I'm on manual recalculation, which means that you won't see things changing until I decide to recalculate my worksheet, which I've just done there with Shift F9 to recalculate the worksheet only. And you can see that my label up the top here has changed so that what you see up the top matches what you see down the bottom here. And having done that, I am just going to clear out pretty much everything. I'm just going to go through and I'm going to delete. I'm also going to do the same all the way up here. I'm going to highlight that. Let's delete all that. We got some fairly heavy duty formatting going on there, but we should be able to get rid of that by just copying and dropping that down. Good stuff. So I'm giving myself a nice clean sheet. Let's get rid of the intersections as well. And we got myself something nice to work with. So let's set up a scenario sheet. Now, modeling scenarios, modeling sensitivities is not that difficult, but it's really worthwhile spending a bit of time giving yourself some context. So what is it that we want to model at the end of this? So I'm going to start by identifying some key outputs. Okay, and there are two that we're going to look at. So the first is a term loan interest cover ratio. What do I mean by interest cover? If I'm calculating an interest cover ratio, what sort of things do you have in mind? What's going to be the number on the top? What's going to be the number on the bottom?
I think there we have a profit before interest and taxes.
Perfect. So that's the number on the top, profit before interest and taxes. And the number on the bottom?
The interest.
The interest.
interest.
Absolutely, absolutely. And so the idea is that if you're making, let's say, $1.50 in profit and you've got interest of $1, then happy days. Yeah, you've got an interest cover ratio of 1.5. If it's the other way round, if you're only generating profit of 1 and you've got interest of 1.5, then unhappy days. So it's very much a ratio that is just, if you like, a safety measure. Are we generating sufficient profits in order to pay our interest? Now, that's a lender ratio that's as good as far as it goes, but there are certain weaknesses with it. First of all, it's based on profits. And we know with our knowledge of debt that actually debt is all about cash. Yep. So I'm going to also look at a second ratio, which is going to be a term loan debt service cover ratio. So it's not interest, it's going to be debt service cover ratio. And this one is generally seen to be a superior ratio because it's focused on cash. And so the number on the top is not profit, the number on the top is going to be cash flow available for debt service, and the number on the bottom is not going to be interest. The number on the bottom is going to be interest plus principal repayment. Okay, so that's a much more effective way of looking at debt and working out whether the project is generating sufficient cash in order to pay back all of the debt. So just give me a show of hands. This could be a way of working out whether, and I'm now struggling to do it, to raise my hand. One moment. How do we, Arup, do you remember where we do this?
It's on reactions, Andrew.
On reactions. Where's reactions gone?
Next to record, share screen.
I can't.
It'll be on your Zoom control. I think because you are sharing, you might have different controls.
Ah, right. Okay. Anyway,
everybody else can see it. I think.
Yeah, there you are. Excellent. So Arup has raised his hand. So all I wanted you to do was just to raise your virtual hand if you've come across those ratios before. If you're happy with those ratios. There we go. Kevin's saying yes. Stephen's saying yes. Now look, it's hands all over the place. Right, good stuff. Okay, and I've got thumbs up from Adelaide. Even better. Wonderful stuff. Okay. So those are the ratios that we're going to be looking at. Now, I'm interested in the ratios at their lowest. So I want to identify the minimum ratio across the whole project. And that's both in terms of my interest cover and in terms of my debt service cover ratio. Okay, so that I start thinking to myself as a modeler, well, I'm going to need to use the min function to look at ratios and determine which is the lowest ratio. Now let's look at a couple of things that we can play around with in order to stress test those ratios. And the first thing I'm going to look at is a exchange rate. So I'm going to look at a US dollar to Kenyan shilling spot exchange rate sensitivity. I'm going to set that up so that we are going to look at an exchange rate and we're going to be prepared to flex it. So what happens if the exchange rate goes up by, let's say, 10%? I'm going to be interested in what will be the impact of an increase in exchange rate against my ratios. Okay. What else are we going to look at? Oh, we should also look at an interest rate. So I'm going to look at a term loan. Now, we've already got a loan modeled in our model, which I don't want to spend too much time looking at. So I'm going to look at the loan that we are about to model, which I'm going to call term loan #2. So term loan #2, I'm going to be interested in the interest rate there. I'm assuming that's going to be quoted on a 30/360 basis, and I'll talk about what that means also in a little while. And we're going to set that up as a percentage per annum. We're going to put an interest rate in there such that equally I can change that interest rate and then see what is the impact on my ratios at the top there. Good, and that will probably do me for the moment. So I've set up a sheet that is going to have two key outputs, two key calculations that are going to be linked to my model. And then I've also got two key inputs set up, which I can play around with in order to see the impact on those outputs. Any questions on the scenario sheet? Yeah, I'm not surprised there are no questions. You're thinking, well, Andrew, all you've done is typed in 4 labels. You haven't done much. But the important thing is that we've started with the end in mind. You know, I now know where I've got to get to by the end of this session. Arup, did you want to add anything?
No, Andrew, I think, I mean, everything, you have covered everything very well. But yes, I mean, from a modeler's point of view, Andrew, just because you asked, so let me add it. I think, you know, starting with end in mind is something, you know, which it's not, it does not come naturally, you know. I mean, it took me a couple of years to get there, you know. Usually when I would get a model, and I would just start modeling as soon as I get it, you know, give me, 5 minutes, yeah, let's start modeling. But then, you know, it was with experience, you know. I mean, not that much experience, but, you know, still, you know, I am a bit experienced modeler now. I can say that, thankfully. So then I realized, you know, I mean, before you start modeling, you always have to know, you know, where you want to end at, because, you know, without it, sometimes you just get lost. So yeah, I think laying out things like you have done in placeholders, that these will be my drivers, and what outputs I want, and then you get into the engine, you know, how to model it.
Yeah.
So yeah,
good.
That's it.
No, thank you for that, Arup. So let's now identify what we're going to need to model. And I know that I'm going to be looking at debt. And let's start by taking a look at my financial statement sheet, where we've got a whole bunch of stuff put together. And again, you know, I'm going to go just tap down my statement of comprehensive income, for example, and just identify anything that is to do with debt down here. And you can see that already I've had a go at this. Here's my favorite yellow color in row 22. So I know that one of the things that I'm going to need to model, I'm going to need to add into my statement of comprehensive income is my exchange rate gains or losses. Now, I am not certain, because this is a modeling course, not a tax course, I'm not certain whether my exchange rate gains or loss are going to be tax deductible. I've made the assumption that they are, hence I've put them up before profit before income tax. Okay, but you know, that's an assumption I've made, and I don't know whether that would be true in real life. Can also see that I've got a line in row 23 called net finance cost. Let's just chart that line. Let's just take a look at that. I'm going to do an F11 quick chart. Caroline, you've got your hand up, I can see. Caroline, did you want to ask a question? No?
No,
okay.
no,
we're good. Okay. So I've just thrown a chart together of my finance costs, and we can see that we've got something that seems to be, well, first of all, we can see something that's looking distinctly unfriendly in terms of negative numbers, but I can see that we've had a go already at, somebody's had a go at putting some finance costs together. And so I'm quite interested in that. We've got some hard-coded numbers going on here, which is presumably actuals. I can see that. We've got pre-forecast hard-coded numbers. I'm going to mark those in yellow again, because I think if I were modeling this for real, I would want to think quite carefully about where my actual numbers go in. And I'm a little bit, you know, there's a bit of me that's saying, I wonder if we can do better than simply pasting them over these columns on the FinStat sheet. So I'm just going to mark those in yellow, remind me to come back to this. And then I can see that I've got some links to my long-term debt sheets. And that's, you know, that's going to be interesting. That suggests that somebody has already had a go at modeling interest. And I can see that interest is being paid, what's this, in the year to the 31st of December 15. And then we've got about half the interest then coming in the following year. What does that suggest to you? If you're paying 155 in year one, but only 78 in year two, what does that suggest to you about what's happening to the debt?
The outstanding balance is reducing.
The outstanding balance is reducing, exactly. Either that or the interest rate is being halved, but I think it's probably, you know, more likely that we're paying back some of the debt. And so I'm thinking to myself, okay, this model is will have some debt repayments in it. And then presumably all the debt gets repaid, because from the 31st of December 17, we've got no interest at all. Okay, and something is also clearly happening as we move from my last actuals period into my forecast period, because that's quite a drop in the interest. So my guess is that as we move from last actuals to forecast, there's some degree of refinancing going on, because otherwise, how would you explain such a drop in your interest, 262 going down to 155? So I'm sensing that there's a fairly big story going on in there that I want to go in and investigate. I'm going to mark my net finance costs in yellow, just on the label there, just to remind me that this is something that I'm going to be interested in investigating. Now let's carry on down, take a look at my balance sheet. Here we are. We've got a non-current loan from MAT Investments. We've got a label there. And again, you can see I've marked this yellow because I'm interested in this. And here's my outstanding balance. Okay, and this really bears out what Keziah was saying. We've now got a balance that was 517 at the end of December 15, and then is completely paid off at the end of December 16. So we still paid interest on a balance, which suggests to me that we're not calculating interest on an ending balance. Yeah, it suggests to me that we're calculating interest on a balance that hasn't yet disappeared. So that's quite interesting to note there as well. And again, let me chart just to get a sense of the debt history. Okay, so a fair amount in my history, a big debt injection going up there. We've got a repayment going up there, another investment going up there, which as I move from my last actuals to my forecast. So I'm just trying to get a high level sense of what the model is telling me simply by looking at these items that I know I'm going to be interested in. I've got a balance sheet that checks, that's all working. And then let's take a look at my financing activities. So we've got net financing costs here. Let's just take a look at that. Again, this looks to me like exactly the same as what we've got up above. Okay, now you're going to find this with collaborative modeling, that when you take on somebody else's model, there are going to be areas where you're going to think, yeah, I wouldn't have modeled it this way. And so one of my concerns up here is that we've got a daisy chain. So I'm just going to make a note of that in my model. I'm going to put just to say question mark daisy chain. Now, what do I mean? What do I mean by a daisy chain? Anybody come across this term before? Jeffrey, I can see you've got your hand up.
Yeah, I'm just wondering what happened to the interest on the overdrafts.
What's happened to interest on the overdrafts? Yeah, that's a good question. And I'm not sure I've got an answer to that yet. Do we have any overdrafts? We'll take a look in a second. Take a look in a second. But daisy chain. What do I mean by a daisy chain? Anybody come across this term?
It's a link to a link.
Precisely. A daisy chain is a link to a link. And the trouble with daisy chains is that if I decide to, let's say, delete this, and I hope I'm going to be able to do this and be able to undo it. So I've just deleted that row, and then let me just get rid of this. If I then come back, I'm getting hash refs all over the place. Okay, where was it? Where was it that I've I've lost it. So I deleted at the source, and I'm getting a number of hash refs, but where was my cash flow gone? Lost my cash flow. Here we go. Yeah, you can see I'm now getting a hash ref on that line, and that's because that I have linked to that daisy chain. Now I'm hoping what I can do is a Control Z to undo, and then I should be fine. I am. But we're going to try and avoid links to links. We're going to always try and link back to the source calculation. Right, okay, good. So that's my statement of financial position. Let's pick up though on Jeffrey's point about overdraft. So the first thing I want to know is, do I have an overdraft? So I've gone to my balance sheet, my statement of financial position. In my current assets, I've got cash at bank and cash in hand. Let's just chart that and see if at any point we go negative. And the answer appears to be no. So we don't appear to go negative. But I suppose, so I wouldn't expect to see overdraft interest. But the other thing that occurs to me is I wonder if I'm paying interest on cash balances. And Jeffrey, that may have been, behind your question as well. Don't know. But at the moment, I'm not seeing any overdraft in operation. Unless I'm missing something. Let's take a look at the liabilities. Current bank overdrafts, I beg your pardon. Right, so what we have is current bank overdrafts on the liabilities side, and then we've got no use for an overdraft going forward. So my guess, Jeffrey, is that the cost of the overdraft is included in your net finance cost for your actuals, and then we are not forecasting an overdraft, so there appears to be no overdraft interest.
That's clear. Thanks.
Okay, good. Now that's a great question, Jeffrey. Let's have more questions like that. Because I want us to tease out what is this model doing and what is this model not doing. Okay. Right, good. On my cash flows, so there's my net finance cost. We talk about the daisy chain here. Proceeds from borrowings, repayments. Here's another one that's just worth taking a look at here. I'm going to mark the actuals in yellow because I want to come back to those. But let's take a look and just chart what we've got going on here. So I can see that presumably here I've got some drawdowns. I'm drawing down on the debt because I'm seeing that as a positive number. I've then got some debt repayments going on here. I've then got another big drawdown followed by two steady repayments. So we've got a lot of capital movements in my debt at the moment. So any questions on what's been modeled so far? Okay, so let's hop back on any one of these links, hop back to my long-term debt sheet. And now what we're into is the detailed calculations that are supporting my calculation of debt. If I have the choice when I'm working with debt, then what I tend to do is I will always start with the balance. And the reason why I like to start with the balance is because the balance forces you to answer difficult accounting questions. And going back to what Arup was saying about you always start with the end in mind, when you're modeling, if you can answer the difficult accounting questions before you start modeling, you are much more likely to come up with a robust financial model. So those of you a bit nervous about accounting questions, and I should have said as part of my introduction, I am an accountant, I'm afraid, 8 years with KPMG. Those of you a bit nervous that I'm about to ask you difficult accounting questions, then this is the point in the session where you're right to be nervous. But let's take a look at what we've got here. So we have got term loan balances in row 41. Let's chart those balances, just remind myself what we've got here. So notice here we've got no actuals. That's because the actuals are being put directly onto the financial statement sheet. So I'm not going to worry about the actuals. And all we've got here is a balance on my debt, 517,800, which then disappears one column later. And so let's see how that has been how that's been put together. I'm going to look at this number here. Okay, and what we've got is we are saying collect up all my loan balances. So I've got my #1 balance, my #2 balance, which is the debt that we have yet to model. So again, notice I put this in as a yellow placeholder, telling me that there is something I need to add in here. And then we have got a forecast period flag, and we're saying take all the balances, multiply by the flag, and that will give you the balance that we want to show in our balance sheet. Now, the modeling of flags, I think you covered earlier in the course with Mohit. And so just to remind you, when I'm looking at a forecast period flag, what this flag is designed to do is to give me a 1 only when I'm in a forecast period. So if I'm pre-forecast, up here I can see a 0. If I'm in the forecast period, I can see a 1. And then if I hop back to my timesheet, just go back to the my timesheet here, a little reminder of the way that that Mohit put the flag together with you, which was this was an if and an and statement. If we have a column that falls in between two dates, in between a start date and an end date, then give me a 1, otherwise give me a 0. And all I'm doing here is using my flag in order to show forecast balances only. Any questions on the use of the flag there? Wonderful. So let's now hop back and see where this balance comes from. I'm going to do a standard control left square bracket. And we come to this modeling structure here. Now, can anybody tell me what that structure is called? Anybody come across the term that describes what you've got in rows 18 through 25?
Corkscrew balance.
It's a corkscrew balance. Thank you, Jane. It's a corkscrew balance. A corkscrew being the device you use to extract a cork from a bottle of wine. And the reason why it's called a corkscrew is because you've got this very distinctive winding structure whereby the previous end balance feeds through into the beginning of your next period balance. Okay, and this corkscrew, very useful, a very important structure going on here. And it's also important to note that the middle items of your corkscrew is what you need to answer the accounting questions. So if I have a loan balance and I say what makes the balance go up, the answer is drawdowns. If I draw down more on the debt, then the balance of the debt goes up. And I can see I don't have any drawdowns. That's interesting. So how do we get a balance at all going on here? Well, we get a balance because we are inheriting a balance at the acquisition date. So I've got an imbalance that I'm inheriting, and then something is happening to that balance. You can see we've got a flag up here, an acquisition date flag that is bringing that initial balance into your model. Okay, so that beginning balance then feeds through into my next beginning balance in column P. We've got no drawdowns going on, and we have got a principal repayment, 517,800. Principal repayment brings the balance down to 517,800, and then the same happens again. And going back to, I think it was Keziah's point, you can now see, here's the explanation as to why the interest halves. Yeah, because we're paying back half of the debt, and then we're paying back another half of the debt. Now, the other thing I've noticed is that we don't have an export here. So I'm just going to remove that red marking and put that back to black. Okay. So there's my term loan one balance. And that we can see under my term loan summaries. I've got my my balance set up there. Let's just again chart that for you. There is the initial balance, and then we're paying back half of that. So we've got 517,800 left over, and then that balance is going in the next column. Any questions on what I've done there? So what I'm now going to do is I'm going to set up a balance for term loan 2. So let's give myself plenty of blank rows. And let's take a copy of this heading up here. We can drop that down. We can make this term loan 2. And I'm also going to take most of the corkscrew. Okay, so I've just taken that and drop that down.
Andrew, allow me to interrupt a bit.
I'm sorry, say that again, please.
Yeah, I was looking for the amortization formula. How did you distribute the two balances there? Do you have an amortization formula somewhere in the model?
Let's take a look. We do. So in your row 23 in your corkscrew, you've got the principal repayment, Jeffrey. If you hop back on that link, you're back at a calculation of principal repayment. And you can see that we've got a balance multiplied by a principal repayment profile, which is just a set of percentages, and they've been set up on the input sheet. So let's hop back to the source there. And you can see, here we go, 50%. You okay there, Jeffrey?
I will review later because I'm looking for a 3-year loan payable quarterly. Maybe the installments could be different, or 5 year. If it's 5 years, then it will be 25%. Is that the implication?
Well, hang on. So where are you getting 3-year loan paid quarterly?
I know that is a 2-year loan, I could say, payable 50% every year.
Correct. Yeah.
So what if it's a 5-year loan? Then I'll divide.
I see. Yeah. So if it's a 5-year loan, then you would need to go back in and change your inputs. So this would then become, let's say 1, 2, 3, 4, 5, and we would have, if my maths is correct, well, let's just do
20%.
20%. 1 divided by 5. Yeah. Okay. So let's try that. Hey, so here's a good test. Yeah, so we've gone back, changed the inputs. Let's see if the model works. Yeah, oh, you're tough on me today, Jeffrey. This is good. Okay, so let's go back and see what happened there. Wow. Okay, so what we've now got is a principal repayment that looks like this. Yep, payable back over 5 years. Let's see what that's done to my balance. Your balance is now looking like that. Yeah, good call. And you can also see that you've triggered 26 track changes, which we're going to take a look at in a little while. Okay, but important thing is that we don't appear to have any errors. Okay, so the model appears to be working. So good call, Jeffrey. Yeah. Good. Right. Let's leave that actually. Well, I don't want to upset Stephen too much. Let's pop this back. I'm going to mark this and just put in a comment to say 5-year loan illustrative for Jeffrey's question, for example. Right. Good. So let me build the corkscrew for my loan 2. I am going to use the structure that I've got from up above, whereby the beginning balance becomes driven off the previous end balance. But what I am going to do is I'm going to simplify this corkscrew. First of all, we're going to make sure that we replace #1 with #2. So I'm just going to do a search and replace there. And then I am going to, what should we do here? Let's remove. So this is going to be term loan #2 principal repayment. I'll get my spelling right in a second. There we go. And I'm going to simplify my formula here. I'm simply going to make the formula equal to the beginning plus what makes it go up minus what makes it go down. Now, the reason I've done that is because I know that this new loan doesn't have any history. There are no actuals to update for this new loan. And so whereas on your previous corkscrew, you had the ability to bring in a historical balance, I don't want that on my corkscrew here. I'm going to make this a much simpler corkscrew. It's simply saying, look, we're going to draw down on the loan and then we're going to repay on the loan. Okay. And then I'm going to make things a little bit nastier. I'm going to make this not Kenyan shillings. I'm going to make this US dollars. Okay, so we're going to put the loan in US dollars. And I am going to take advantage of my placeholders here and just hack in some numbers. Just give us something that we can work with. So I'm assuming that I'm going to draw down as the following. I first draw down on the 31st of December 2015, and we draw down $10,000, followed by 5,000, 5,000, followed by 10,000. Now, I hope that you're all thinking, hang on, that's pretty poor. That's pretty bad modeling going on there. But remember, the background color is yellow. So this is just a temporary bit of modeling to get something into my model so that I'm confident that it is working. So that's how we're going to draw down. And then here's how we're going to repay. We're going to repay, let's say 20% of the balance. So, you know, this is really bad modeling now. I've got 30,000 in total. I'm going to pay back, let's say 20% of 30,000 in the 30th of December 19. And I'm going to do the same again, 31st of December 2020. Okay. And then when I do a Shift F9 and recalculate, you can now see what's happening to my balance. So let me now chart that balance. You can see the balance going up with my drawdowns, okay, and then the balance coming down again with my repayments. But because I'm only repaying 40%, I end up with a hanging balance at the end of that forecast period. Any questions on what I've set up there? Okay, good stuff. Now, a couple of other important things for me to do. Very, very important that I change my label to make it clear that this is a US dollar term loan. Why? Because otherwise the risk is that you link something through to your financial statement sheet. Your financial statement sheet in Kenyan shillings, you link something through in US dollars, and then you wonder why things don't work. Okay, so I'm going to be very, very careful with my labeling. US dollars all the way through to remind myself that I am working in a currency that is different from the main currency of my model. Okay. And what I'm then left with is the idea of saying, well, okay, once I've got my term loan balance in US dollars, then I'm going to have to convert it back into Kenyan shillings. And for the moment, I'm going to make this really quite simple. I am going to say, well, let me link to my balance. Bear with me 1 second, please. Let me just sort out the color formatting there. I'm going to link to my balance. And then I'm going to convert back into Kenyan shillings using some sort of exchange rate. I'm going to use a USD to KES spot exchange rate. And I'm going to assume, for now, I'm going to assume that that is simply going to be 100 Kenyan shillings to $1 US. Okay, I've just stuck 100 in there. I've copied it all the way across. That will do me for the moment. And what that allows me to do is then just multiply the two things through. So term loan #2 balance. That's going to be in Kenyan shillings, and that's going to be A times B. Any questions as to what I've done there?
Perhaps just a comment. Since the MAT model assumes the currency is Kenya shillings thousands, perhaps we can put it in Kenya shillings thousands. Yeah.
Perfect. Yes, we can. Like that, you mean? Is that what you mean?
Exactly. Yeah, exactly. Yeah.
Does that mean that my exchange rate is then wrong?
Perhaps you could also assume that the US dollar term loan is in thousands as well.
Yeah, I'm with you. I'm with you. That's a very good call. Thank you very much for that. I was suddenly thinking, have I got my Kenyan exchange rate? Is it actually 10,000 shillings to $1? But no, actually 100, which means that you're converting from US dollars. Okay, Kevin's made such an important point here, and he's picked me up in terms of getting my units right. And this is one of the reasons in financial modeling why we want to be absolutely scrupulous, absolutely clear in my units. So let me just check in with Kevin. Are you happy with that? I'm now saying I'm taking thousands of US dollars. I'm multiplying by a Kenyan shilling to dollar rate, and that's giving me the answer in Kenyan shilling thousands.
Yeah, that's fine.
Right, good. Excellent. Thank you very much. Now, that's my term loan 2. And I am now going to link into my loan summary. And I'm thinking now, actually, I could do a bit better job here. Let's make you made use of a named cell here, I think, which you called standard monetary unit. That's better. Now I've got consistency with my label. Okay, so that's the first thing in terms of modeling the debt. We have put the corkscrew together. We've modeled the balance. The complication here being that I've had to model the balance in US dollars. I've then had to convert it to give me a balance in Kenyan shillings, and I've then linked that through into my balance, my loan balance, which is then feeding through into the balance sheet. Okay, good. Any questions? Jeffrey, please.
No, I'm okay, thanks.
You're okay. All right, good stuff. Okay, let's push on. Let's now look at my drawdowns and look at my principal repayment. Let's start with the drawdowns. So I know roughly what they're going to be. I've got 10 million in this period, 5 million, 5 million, 10 million. So we've got date dependent constants going on here. If I go back to my loan 1, was there anything to help me in terms of modeling drawdowns here? Answer no, I had nothing here. So there's nothing for me to pinch, nothing for me to use. So I'm going to need to set this up from in Scratch. And let's do that down here. So we're going to, let's give myself a heading here. This is going to be my USD term loan #2 balance. And we're also going to have a USD term loan #2 drawdowns. So let's put that together. I know that my first drawdown is going to be on the 31st of December 2015. And I know that we've then got 3 drawdowns on the anniversary of that. So I want a function that is going to give me a date that is exactly 12 months later. And for that, I'm going to use the EO month function. So I'm going to look at my 31st of December 2015 and say, give me a date that is a year after that. And I'm just going to copy that down to give me 4 dates to play with. And let's see if we can do something sneaky here. I should now be able to take my drawdowns. Let's just copy those. And I very rarely do this, so this could go horribly wrong. But what I'm looking for is a paste special, and I'm looking to transpose. Here we are. Let's try what happens here. What do you reckon, Arup? Is this going to work?
Let's find out. It should work.
Yeah, I might keep it safe and pop the values down as well. But I'm going to do a paste special values, and I'm going to do a transpose. I so rarely do this, so I'm a bit nervous about what's going to happen now. But I've taken something from the horizontal, and if I've done this correctly, oh, there we go, fantastic. It's pasted it down in the vertical. Yeah, that paste special menu, Control-Alt-V to bring up your paste special menu, really useful one. Lots of useful stuff to go in there. And then let's pop in my US dollar thousands as my units in there. Okay, and so we've got a drawdown schedule that we can play around with. The reason why I've put this in the vertical is because I want this to be part of my scenario manager. Okay, and I don't want the inputs to be going across the horizontal, because I want to be able to easily chop them out and replace them with something else. And so then what I'm going to do is put together a structure that I'm guessing you've seen before. You would have learned this structure with Mohit. So I'm going to find myself some model period ending dates. Here we are. Let's link those through, set up some dates. There we go. And then if I wanted to calculate my USD term loan #2 drawdowns, does anybody remember from the session you did with Mohit, what function would you use in order to take constants in the vertical and allocate them across a horizontal timeline? Does anybody remember?
The VLOOKUP?
VLOOKUP, Kazara, absolutely. That's the one I would go with. The VLOOKUP. So a reminder, what we're going to say is look for the date in the timeline. You look at the leftmost column of a table that you define. We're going to return the answer from column number 2, and I am interested in an exact match, for which I need the word false. Okay, now what that does to begin with, quite alarmingly, is give you a not applicable. Okay, you think, well, that's not a very good start. So what I'm going to do in my label is indicate that a not applicable is a possibility. Okay, and then let's copy that across and see if things improve. What I'm interested in is, here we are. So we get not applicable going across, but then on the 31st of December 15, we're getting the 10 million that's being invested at the 31st of December 15. 10 million, 5, 5, such that if you decided to change this up here, if this becomes 100 million, for example, then you're going to see that 100 million updating up there. How am I going to deal with these not applicables? Well, very simply, I'm going to come up with a clean label. And then this simply becomes if the cell above is showing not applicable. So if there's an ISNA, if ISNA, then show me a 0, otherwise show me the cell value. And that will clean up your not applicables and then give me my drawdowns. Okay, so there's just an example of the sort of things that you were looking at with Mohit on that in that first session you did with him. There's an example of it being deployed in debt modeling. And the reason for that, the reason why I want to go from vertical to horizontal is because this then becomes really important for me when I come to build my scenario manager. Any questions, any comments on what we've done there? Fantastic. How are you all doing in terms of, sorry, there was a question. Kevin.
Yeah, I have a question. What if you used an if error or, you know, a different function other than ISNA?
Yeah, so the trouble with if error is that if error corrects all errors. And the only error I want to correct is a not applicable error. If I've got other errors latent in my model, I want to know about them. So I'm being deliberately very specific. I want not applicable errors only. Okay, thanks, Kevin. Now, how are we doing pace-wise? We've got about 50 minutes to go. Is everybody okay? Yeah. Fantastic. All right. Let me push on. So what I'm going to do now is I'm going to relocate these inputs to my send sheet, to my scenario sheet. And I'm going to do that by setting up a link to that. Now, in F1F9, we have a little macro that does this for us. So, I mean, it's a very simple macro in that what I'm doing is a very mechanical thing. But I'm just going to run that now. I'm going to say, let's relocate all of these inputs, and we're going to send them off to the scenario sheet. And so what happens is you've now got this links to the input sheet. So if I hop back on the input sheet, you can see that there we are, or beg your pardon, on my scenario sheet, you can now see that we've got those set up, which means, what am I going to call this? Let's call this term loan #2, and this is going to be my USD drawdowns. USD drawdowns years ending. Okay, so I've now got those inputs set up on my input sheet, which is going to be helpful again when I want to play around with this sheet and see the impact on my model. Let's go back to my long-term debt sheet. You've got those links driven off the scenario sheet, and we've now got my drawdowns modeled, which I can then link through into my corkscrew. Copy that all the way across, and we've now got a link up to my drawdowns. Okay, any questions on what we've done there? Wonderful. Now, if I take a look at my drawdowns in my loan borrowings or repayment down the bottom here, I can see that I've got a placeholder for my drawdowns. And again, I could link those through. But first of all, what I need to do is I need to convert from US dollar back to Kenyan shillings. So I'm going to take a copy of this block that I used for my balance when we converted back to Kenyan shillings. Just take a copy of that, and we're going to drop that down under my drawdowns. Link to my drawdowns. And then this isn't term loan #2 balance. This is my term loan #2 drawdowns. Let's have a row total in there. I'm expecting that to be 3 million. Yeah, that's looking good. Okay, and then that I can link through to my summary. So term loan 2 drawdowns. Link to the label, and we can copy that across. And then just to remind you there, those drawdowns that we've modeled feed through into a calculation of drawdowns and principal repayments. Let's just take a look at what that is doing. That's simply saying add the two together, multiply by a flag, and that is what we're taking off to our financial statements. Any questions on the modeling of drawdowns? Wonderful. Okay, I'm going to repeat the process for my principal repayment. Principal repayment, I do think we have something a little more useful, because I seem to remember that principal repayments were modeled on loan 1. So let's take a look at loan 1. Yeah, we've got an initial balance. We've got a principal repayment profile. That can give me my principal repayment. So let's take a copy of that. It'll give us a structure to play with. And let's just pop that in there. This becomes USD term loan #2 principal repayment. Now, what I don't want here is an initial balance. So let's just delete that for a second. What we want here is my USD term loan #2 drawdowns sum. So we want the sum of the drawdowns that we know is going to be 30 million US dollars. For my principal repayment profile, let's take a look and see what assumptions we made down here. Well, we said we were planning on paying back 20% of my 30 million in each period, in this period here and in this period here. So I'm just going to pop in 20% in these two columns. Okay, already you can see that something is working. Let's go back. This is going to be my USD term loan #2 principal repayment profile, and that's going to be my percentages. Okay, and that's going to be US dollar term loan 1. Let's also link that through into my corkscrew. So what we can now see in dollar terms is that we are drawing down 30 million in the blue. That's my drawdowns. And then we're repaying 20% of that 30 million in columns 11 and 12. And then, working with my placeholders, I can continue to, if you like, model backwards. So I'm now saying, well, how would I calculate my US dollar term loan #2 drawdown sum? Where am I going to calculate that? Well, it strikes me that perhaps the easiest place, or a sensible place to do it, would be where I first calculate my drawdowns. So I'm going to do a little trivial calculation. where I'm simply going to say, I now want a trivial calculation where I'm going to take the label above and I'm just going to add the numbers together. I want that in column F. So that's going to be equal to the sum of what we've got above. I can then link that through. So that you have now got the sum of that driving the principal repayment. Which means that if we decide to choose to change, I should say, any of these numbers here, then that is going to flow through. That will change your drawdowns. That will change the sum of your drawdowns. That will then change how much we are repaying in each period. Any questions on what I've done there? My repayment profile, I'm going to use exactly the same VLOOKUP approach that I did for my drawdowns. I've only got 2 repayments. I've only got 2 dates to worry about. So let's just take this lot and drop this down. I'm then going to replace that with yellow. And let's check to see what the dates were. What have we got? 30th of December 19, 30th of December 20. So that becomes 31st of December 19, 31st of December 20. These are going to be percentages, 20%. And that's going to be percentage. Okay, and let's set those up as inputs. So those are my 20% in each period on the following dates. Model period ending remains the same. Those dates remain the same. And therefore, we're then going to have a USD term loan principal repayment profile. And I should see, there we go. You can see the percentages coming through here. And so we're going to use exactly the same ISNA approach in order to pick up the correct percentages. Any questions on what I've done here? Good. Let's link this through, replace my placeholder, copy that all the way across. And that's my principal repayment profile now properly modeled. And then the final stage, I can relocate these to my scenario sheet. So what I'm hoping you're getting a sense of is that I'm using this rough yellow color as a way of quickly and easily sketching out an answer. And you'll see, I'm doing all sorts of bad modeling in order to get that done. And then I'm working backwards to the source, putting things correctly in place so that the model is now robust and dynamic and everything is feeding and flowing through properly. Okay, why have I got a US dollar term loan #1 principal repayment in the middle of my term loan #2 balance? That doesn't look terribly sensible. Yeah, okay, so I'm seeing that I've got a little bit more to do. This is a #2 principal repayment, and it's not in KES thousands, it's in US dollar thousands. That's more like it. Right, there we go. And that is now flowing through nicely. Okay, good. let's now take a look at my summary down the bottom here. My term loan principal repayment, that is now ready to be linked through, but notice I need it in Kenyan shillings, not US dollars. So again, I'm going to take a conversion working that I did up here, and we're going to drop this down for my principal repayment. Link to my term loan principal repayments. That feeds through there. That's in US dollars, Kenyan shillings, and that's going to give me a, let's take a copy of that, paste that down. Term loan to principal repayment. And let's link that through. Right, good. Any questions on what we've done there? Wonderful. Well, that's the bulk of my debt calculations done. The one I obviously haven't done is interest, but we can look at interest in just a second. What I'm going to do now is I'm going to make things a little bit nastier by changing the exchange rate. And this is where the modeling gets a little bit tricky. So everything I've done up till now has been, you know, fine, fairly easy. I hope fairly easy to follow. I've got my drawdowns, I've got my repayments, I've got my my balances in place. But what happens if we change the exchange rate? And so what I'm going to do is I'm going to construct an exchange rate. Where should we do this? Let's just do this up the top here. I'm going to play around with an exchange rate. The first thing I want is my sensitivity. So I'm just going to take a copy of that sensitivity. We can drop that down and we'll leave that as a 0 at the moment for my sensitivity. But I want something where I can play around with this sensitivity. And then I'm going to take my current exchange rate. So let's take my spot exchange rate up there. Pre-forecast period, I'm not going to worry about that. Let's delete that for the moment. But then I'm just going to make some manual changes here. So I'm going to assume, let's do a fairly simple assumption. I'm going to assume that dollars become more expensive to purchase. So I'm going to start by saying, look, every period, things just go up by 2%. So if I shoot that across, there we go. So if I chart my exchange rate, what I can see is I've got an exchange rate that is rising. And let's add a little, let's add a sensitivity into that, because I want to be able to play around with that exchange rate. I might want to bump it up more. Might want to bump that down less. I'm going to need a flag, because I don't want to run this sensitivity on an exchange rate that I know is going to be fixed when the model, when the model hits that last actuals date. I know that 100 is going to be fixed. So I need an acquisition date flag. I have seen one, but I can't think where. So let's put in a placeholder. Oh, I know where I've seen one, on the corkscrew. Where's it gone? Here we are. Let's take a copy of that flag and we can drop that in there. And let's set up some exchange rates that we can flex with a sensitivity. So this is going to be my base rate, and then we can have, if the flag equals 1, then I just want the exchange rate. Otherwise, I want 1 plus the sensitivity multiplied by the exchange rate. So the sensitivity is at 0% at the moment. We've got a 2% rise, which is the one that I've hacked in temporarily. But if I then pop this up to a 10% rise, you can then see that these figures are going up quite significantly. Okay. So now let's replace my nice, convenient, my exchange rates that never changed. Let's replace those with exchange rates that do change. So I'm going to link to my exchange rate up the top here. And then having linked that once, I'm then going to take a copy of that link, that existing link, and just drop them down wherever else I've got a spot exchange rate that I need updating. Right, good stuff. Now, when I do a full recalculation of the model, slightly surprised that I'm not getting any error checks. That's because I would have thought that by now I would have a balance sheet problem. So I'm slightly, that is, I mean, where's Kevin gone? Kevin, I'm genuinely interested as to why that's not giving rise to a balance sheet difference. That might be something that we want to take a look at.
Yeah.
Sorry, Kevin.
Yeah, I'm having a look at the template to see.
Yeah. Okay. I'm also interested. I'm looking at the wrong. Hang on a moment. Hang on a moment. That's better. That's what I'm after. Right. Good. I was looking at the wrong financial statement sheet. That didn't help matters. Okay. That's exactly what I'm after. So, yeah, you might want to just check your error checks there. So what I've now got is a balance sheet difference. Okay, and that balance sheet difference, I am guessing, is to do with that foreign exchange. And let me demonstrate that to you. If I go back to my my placeholder for my foreign exchange, and if I pop this back just to going 100 all the way through, you can see we've got no error checks. Okay, so I know that that foreign exchange difference is giving rise to a problem in my model. Let me put that problem back in again. So we said equal to the previous multiplied by 1 plus 2%. Shoot that across. Yeah, again. There we go. I'm seeing that error check. Right. So what we now have to do in order to calculate the, or in order to get things to balance again, we are forced to calculate a foreign exchange gain or loss. And the best way that I've got to explain this is to think about whether it's becoming more expensive or whether it's becoming cheaper to draw down or to repay. And if you think about it, as things are, well, actually, let's take a look at the principal repayments to begin with. So you can see that even though we know that we're paying back $6,000, in this period, it costs us 728,000 Kenyan shillings in order to pay that back. In the next period, it's got more expensive. which suggests to me that from this alone, this is going to give rise to some sort of loss. It's becoming more expensive to pay back the debt, and therefore, you know, I'm expecting to see some sort of loss. If you look at your drawdowns, though, your drawdowns, and let me see, can we look at this? Yeah, let's look at those 2 5 millions. In your drawdowns, can you see you've got the opposite effect? So we're drawing down $5 million in those 2 periods, but because exchange rates are rising, it's actually becoming cheaper to purchase the dollars, or you know, the dollars that we're in receipt of. We're then getting more Kenyan shillings when we convert them. So you've got the opposite there, which I would expect to give rise to a foreign exchange gain. Now, you can get yourself into a whole host of problems when it comes to calculating foreign exchange. So I am going to make a couple of big simplifications, which for this sort of modeling, I think is going to be fine. Okay, the big simplification I'm going to make is to assume that all of my cash flows are end of period cash flows. And what that means is that I can justify converting all my flows using a closing rate. And if you're thinking to yourself, well, what's a closing rate? Closing rate is what we've modeled up here. So we are saying at the end of each period, we are assuming an exchange rate that follows like this. Now, I need to get a tiny bit into accounting standards at this stage. What accounting standards say is that you have to convert your balance using a closing rate, but you can convert your flows using basically using whatever you like. It's a slight simplification. But my recommendation to you is build a model that assumes end of period cash flows, and then you can use the same rate for both. And what that does is it simplifies your calculation of a foreign exchange gain or loss. So let's take a look at that. I'm going to set up a little calculation. Let's pop it above my my term loan summaries, which is going to be my forex gain or loss. And I'm going to need 4 ingredients followed by a forex gain stroke loss at the bottom here, and that is going to be in Kenyan shillings. It's going to be at the bottom there. Right. Now, what I'm interested in is my balance. I'm interested in what are the gains or losses arising from the balance, and that's going to go through, and that, you know, that's going to be driven by my balance sheet. When I link my Kenyan shillings balance through to my balance sheet, the changing rate is going to have an influence on the balance. But I also know that I am converting the flows. I'm converting my principal repayment, and you can see that I did so up here. Yep, I took my principal repayment and I've converted those at the flows, and that's going to go off to my cash flow statement. Likewise, my drawdowns, I'm also converting. Now, what will happen is that if you convert your end balance using the same rate that you convert your flows, then what will happen is that the gains or losses will match each other and will cancel each other out. Which means that the only element of the balance you need to worry about when calculating a gain or loss is the beginning balance. So this is a tiny bit tricky conceptually. What I am saying is that if you're assuming that all of these 3 things are being converted at the same time and at the same rate, then the only thing in the balance that's going to give rise to a gain or loss is the beginning balance. Let's try it. I'm going to set up a link to my beginning balance. Shoot that across. I then want my exchange rates. Here we go. Let's take these in row 83, drop those down. Why is that showing a 1? I wasn't expecting a 1. That suggests to me, oh, I've got a wrong calculation in here. That should be 037. Arup, you kept very quiet on that one. Were you just letting me trip myself up on that?
I missed it too, Andrew.
You missed it too. Oh, okay. All right. That's pretty poor of us both. Right. Okay. So there's my exchange rate starting at 100. Down we go. Then what I'm going to do is I'm going to calculate my US dollar term loan. #2 balance beg. I'm going to do that at the current period exchange rate. And then I'm also going to calculate it using the previous period exchange rate. So I'm going to compare the two. Now let's work out what we're doing here. We're moving from US dollars to Kenyan shillings. I'm expecting to multiply these through. So the current period is going to be equal to this multiplied by this. Okay, I'm just going to take the current US dollar balance, multiply by the exchange rate, and that is going to give me a balance in Kenyan shillings. At the previous exchange rate, well, that's going to be equal to the balance multiplied by the previous rate, which is going to make use of column I, and I'm just going to mark that in gray to show that that is a cell being used. Okay. So just think this through. If you have a beginning balance currently valued at 1.144, and it was previously valued at 1.122, do you think you've got a gain or a loss? You currently owe 1.144. You used to owe 1.122.
A loss.
It's a loss. Yeah, you owe more than you owe more than you did when you first started. Okay, now if I want to show my loss as a negative number, pop that in there. Let's just remind myself what I want. This minus this. So let's do pop that in there. It's going to be this minus this to give me the loss. And let's give myself a row total there. So I've got a loss of 323,286. Let me just check on this error checks. I think, Kevin, what I'd like to do is just replace it with...
yeah, that's fine.
Here.
Yeah, since we don't have a checks sheet, doing that covers everything. Yeah.
Okay, good. Right. So there's my gain or loss. And let's, I think, have a go at taking that through to my financial statements. So let's mark that as an export. This is going to go off to my profit and loss, and I am going to link that through. Let's go to my financial statements, remind myself where it is. Exchange rate gain or loss. Here we go. So I'm going to set up a link to what I've done on my long-term debt sheet. And let's see what that does. There we go. Okay, so we've now got 0 error checks. You've got the balancing, and that foreign exchange calculation of gain or loss is bringing everything back into kilter. Any questions on what I've done there? Right, fantastic. Okay, now I'm going to need to speed up a little here because I'm aware that I've only got 18 minutes to go, and there's a fair amount for us to do. But we have got something that is now basically working in terms of my debt and being able to manipulate my debt and moving us towards doing our calculations. So let's go back to the scenario sheet and just think about what we can now bring in or what we've got left to do. So I'm going to need to calculate an interest cover ratio, for which I'm going to need to calculate interest. Well, we'll look at that fairly quickly. Actually, what I think I will do in the interest of time, I'm going to skip the interest cover. I'm going to go straight to the debt service cover ratio. So let's get that modeled for you quickly. We have now got a spot exchange rate sensitivity. We've now got that up and running, so I can relocate that sensitivity to my scenario sheet. So let's relocate that now. Send that off to my scenario sheet. There we go. And then let's just cut and paste that. Drop that down there. Okay, so that is now driving the entire model, my foreign exchange sensitivity from that. Let's put together a debt service cover ratio. Let's put together a quick ratio calculation for that. Now, I'm going to drop that down under my summaries down here. We're going to calculate a debt service cover ratio. I'm going to look to my financial statement sheet. And what I want is a cash flow available for debt service. Let's take a look, see what we've got. So what I've got here is I've got cash from operations. I've got net cash used in investing activities, and that is everything before my financing activities. So what I'm tempted to do is actually take these two. Let me just check that that makes sense. That looks good. That looks good as well. Okay, I'm expecting Kevin will tell me if I've got this wrong, but that's where I'm planning to start. So let's go to my cash from operations, and I also want my net cash. Let's add these together to give me my cash flow available for debt service. Just get a rough idea as to how much cash we've got. Okay, so from my forecast period onwards, from period 7 onwards, that's looking fairly healthy. We seem to be generating sufficient cash for that. So that's the number on the top. The number on the bottom is going to be my principal plus my interest. So let's take a look at that. I want my principal repayments. Where am I going to get those from? Here we are. Principal Sorry, let me just bear with me a second. Let me just think how we're going to do this. Probably better. Let's take my term loan 1 principal repayment. Drop that down. I want my term loan 2 principal repayment. Drop that down. And then we're going to want the interest as well. Well, my term loan interest, we can take this one here. Now, I know I haven't yet modeled term loan 2 interest, but that will do me for the moment. Okay, so it's going to give me a rough idea. We're going to call this term loan debt service. Check my units in there, add those together. And then let's just give ourselves a sense as to how this ratio is going to be. So cash flow, term loan debt service. Let's just chart them. take a look at how we're doing. And what you can see, I mean, on surface level, it looks like we are going to have no problem repaying this debt. Now, bear in mind that I've yet to model loan to interest, but this is looking like we have just got plenty available for us to repay. Okay, so I'm not that fussed at the moment, but let's push this on. I'm going to get myself a I'm going to put together a flag. Actually, this is going to be a DSCR calculation date flag. I'm just going to hop in here where I want to calculate the ratio. It's effectively only going to be where we've got debt service. Now, I'm doing that flag temporarily for the moment, but you know how to model flags. You can put that properly on the timesheet, but that will do me for now. Okay, we can then calculate the ratio. This is going to be a term loan DSCR. If the flag is equal to 1, then I want the top number divided by the bottom number. Otherwise, I want a not applicable. Shoot that across. Let's take a look here. Nice healthy ratios here. Plenty of scope to take on more debt in this project is what I'm looking at here. And then let's calculate a minimum ratio as well. So minimum ratio of 8.9069. Right, let us link that through. Back to my scenario sheet. And we can now link through. So here's our first main output. Such that for your sensitivity analysis, you can now play around with this. And I'm hoping when I change that to 20, you're going to see that ratio change. What would you expect it to do if the exchange rate sensitivity go up? Is that going to make the ratio better or worse?
Worse.
Worse, says Kevin. Let's see. So it's currently at 8.9. What happened? Yeah, now it goes down to 8.33. Okay, pop that up to 30%. 7.8. Okay, so what we've now got is the ability to look at this, look at these key changes, simply all on the same sheet. Right, any questions on what I've looked at there? So what I'd like to do, just with the limited time available to me in the last 10 minutes, what I would like to do is to show you how we build scenario managers. So what I've done is I've shown you the sensitivity analysis. You can see the sensitivity set up here. You're changing the sensitivity. You're seeing the impact on the ratio. But what if we had different drawdown profiles? So for example, what if we had a drawdown profile that looked like that, but then we had another one that said, you know what, I think we can borrow twice as much each time. So this becomes 10 million. And then we've got another one that just says, look, let's just go for 30 million in each period. How do we then bring through multiple inputs into my model? And that's what I would like to end the session with, showing you that. And it works like this. We are going to set up what I'm going to call a scenario manager. That relies on having a scenario name and a scenario number. Now, your scenario name, you might have a base case, you might have debt 1, you might have debt 2. And because you might have even more, I'm going to put boundaries around this, allowing me to put new scenarios in quite easily. So I might want a det 3 scenario in there, for example. And then if I decide I no longer want det 1 or det 2, I can delete those. And I'm doing this within the boundaries. So the boundaries give me, you know, they say insert in between these columns, in between column I and column M. What I can then do is come up with a scenario name that is driven off my labels. And for that, I'm going to use data validation. And again, Mohit showed you, I seem to remember in the first session, showed you. So I'm going to restrict the values that I'm going to show to a list. And that list is going to be, oh, this always puts itself in the wrong place. That list is going to be driven off those names, including those gray columns. What you then get is a nice little drop down, which means that I can choose. Am I going to show the base? Am I going to choose the det? Am I going to choose, you know, whatever det? If I decide then to put in another scenario called Andrew, then you can see now the drop down has updated and you're seeing Andrew in there because of the role of these stretch columns. Okay, they allow you to insert in between and it'll expand and contract accordingly. So I've yeah, in fact, let's give Andrew a let's say Andrew wants to draw down 40 million in that first one. Right, then we can drive a number of this. To come up with the number, I'm going to use the match function. The match function says, look up the label and find it in a set of data. And once you've found it, return its position. Is it in position 1, 2, 3, 4, or 5? And what we are looking for here is an exact match. So it's a bit like VLOOKUP in that respect. We're saying we want an exact match here. And what this does is to say that we have got det 3 is in position number 5. Why is it in position number 5? 1, 2, 3, 4, 5. Okay, so that's scenario number 5. What we can then do is replace all of these numbers that we want in our scenario with a formula. And the formula is going to be index. Index, again, I think Mohit took you through how index worked. So what we're going to say is look at my set of data that I want to bring in here and return whatever data is in the position determined by the match. That's position number 5. Now I can change back to the base. And we're back driving off that first scenario. I can now look at det 1. Keep an eye on the ratio there. Let's see what happens if we drive, what happens to my ratios if we drive off det 1. Well, much heavier det. Can you see the minimum ratio is now much lower? Let's go on to Andrew. Let's see what Andrew does to his ratios. Yeah, we're going way down, 2.55. Any questions on the scenario manager? Okay, so look, I'm going to need to bring things to a bit of a close. And so let me just go back to my temp sheet and let's work out what I managed to do and what I didn't manage to do. So scenarios and sensitivities analysis, we did that. We looked at setting up a scenario worksheet and we looked at the difference between sensitivities, which is where you've got one input that you're playing with and seeing the impact on an important output, and scenarios, which is where you're bringing in different inputs and you're chopping out, you know, you're using this structure up the top here to choose which scenario that you're going to run. Okay, so that's the first thing that we looked at. we looked at the modeling of debt. What I didn't manage to cover was the calculation of interest, but I'm going to leave you to take a look at interest. You'll already see how we've modeled interest in relation to into debt one. So that calculation is there. I'm going to leave you to take a look and see what you can, how the modeling of interest would come in there. What we did look at though was foreign exchange considerations. Okay, was the idea of well, what if we've got US dollar debt and how we would deal with those gains or losses. We certainly looked at ratios. We talked about the interest cover ratio. We modeled a debt service cover ratio. What I didn't do though was take you to look at the track sheet. Let me do that just very briefly now, just to point out that the track sheet, it's in your model. What this is designed to do is to show you the difference between stored results of the model and the results of the model that you've just calculated. So what this tells you, this track sheet tells you, is what damage have we done to our model. And you can see, for example, that as a result of the work that we've done, we've managed to increase net finance costs by 233 million. We've also, that's had an impact on my profit figures. That's had an impact on tax. So you can go down and see what has what's happened and the impact of our modelling on what we've done here. Okay, so I'm going to leave you to take a look at that track sheet on your own. Let's go back to my temp sheet. We certainly looked at scenarios. Break-even testing analysis, all I would mention here is that if you know that you have a minimum ratio, let's say of, let's say 2.5, and you're worried about exchange rates, then you can run a goal seek. You can say, well, look, what increase in my exchange rate sensitivity would lead to a ratio of 2.5? The way I'd do that is I would go through my goal seek. So I've gone through the menu, what if analysis, and then G for goal seek. Let's set this ratio to 2.5 by changing my sensitivity. And we can see that a 12.7% increase in your exchange rates would lead to you coming close to breaching that ratio. I am going to stop there. I'm going to save my model at this stage. I'll make this available to Kevin for him to hand over to you. And I've also got an end model which covers a little bit more as well for you to take a look at. But any final questions, any final comments before I wrap up here? In which case, thank you very much, everybody, for your kind attention. And I do hope you enjoy the rest of the course. If you've got any follow-up questions, then please put them to Investia and we'll see if we can get you some answers. It's been a pleasure working with you. Thank you very much, everybody.
Thank you.
Thank you so much, Andrew. It was a very interactive session and I think everyone has enjoyed the session. Thank you so much also for the participants. Kevin shared some assignment. Please hand it over if you're through with it. And also for Friday's Q&A, we think same time at 11, I think is the best time to do the same, right? In case you have any suggestion, you can share on the WhatsApp group. But thank you so much, everyone. We'll see you Friday.
Thank you, Andrew.
Thank you, Joyce. Thank you. Bye. Have a lovely day. Bye.
Bye.